Welcome to the Deep Dive. We take complex financial reports, slice through the jargon, and hopefully give you the strategic insights that matter.
And today, we are definitely diving deep into a giant PepsiCo. We're looking at their third quarter 2025 results, which just came out.
Yeah, we've got the earnings release, the full 10Q filing. That's for the 12 and 36 weeks ending September 6th.
And our mission really is to unpack these numbers because honestly, if you just read the headlines, focusing on the standard GAAP figures, well, you'd get a really skewed view of how they're actually doing.
Skewed is putting it mildly. I mean, look at the reported earnings per share, the GAAP EPS. It looks like a disaster. Down 11% for the quarter, $1.90 a share.
And year to date,
Down a whopping 29%. 29%. That just screams trouble.
it is a really shocking number. And it points to some huge strategic shifts and, accounting charges that we absolutely have to get into.
Right.
But that shock value is precisely why we immediately look at those non-GAAP measures they provide. Core earnings and constant currency figures. Once you adjust for all the one-off items, the big asset write-downs, the costs from buying new companies, you start to see the underlying operational picture. And that core constant currency EPS, it was only down 2% for Q3.
Only 2% and year to date.
Down just 3.5% year to date.
Wow. Okay, the gap between down 29% and down 3.5%, that's enormous.
It
It tells you the core business, selling chips and soda day to day, it's holding relatively steady. But the big picture strategy, wow, they're making massive moves, including admitting some past bets didn't work out.
Yeah,
And those decisions basically wiped out a huge chunk of reported profit this year.
exactly. That gap is the strategic story here.
Yeah.
And this fits perfectly with what the CEO, Ramon Laguarta, has been saying. He emphasized the priorities for 2025 were, and I'm quoting here, to accelerate growth and aggressively optimize our cost structure.
Okay.
So the game plan seems pretty clear. Use innovation, tweak the pricing and packaging, what they call price pack architecture, and really focus on right-sizing our entire cost base.
So use pricing power, cut costs wherever possible, and use that breathing room to make these big strategic plays.
That sums it up nicely.
All right, let's tackle the operations first then. The top line revenue. How did that aggressive pricing strategy actually translate into sales?
Well, the overall consolidated revenue was okay, stable, but not exactly setting the world on fire. Reported net revenue grew 3% in Q3
Okay.
and just 1% for the year so far.
And the organic growth, that strips out the acquisitions and currency effects, right?
Correct. Organic revenue growth was also pretty modest, only 1% for Q3, and slightly better year-to-date at 1.5%. So, steady, but definitely not the accelerated growth they've mentioned yet.
Okay, but how they got that growth, that's where it gets really interesting, isn't it? Because it wasn't
Okay.
from selling more stuff.
Not at all. The growth came entirely from pushing up prices. We saw a pretty hefty effective net pricing increase, plus 4% for both the third quarter and the year-to-date.
4% globally.
Right.
That shows some serious pricing muscle, being able to pass costs on to consumers like that.
It does, but there's always a but.
Yeah, the pushback.
Exactly. Consumers are definitely reacting. That 4% price hike was largely canceled out by a pretty significant drop in organic volume across the board. Volume was down 3% in Q3
Oof.
and down 2% for the year-to-date. So it confirms the strategy we talked about. They're choosing higher profit per item over selling more items.
A classic trade-off.
A classic trade-off. And we also have to mention the currency fluctuations, foreign exchange, or FX. That's always a factor for a global company like PepsiCo.
Right, the global finance headache.
You got it. For Q3, FX actually helped a tiny bit, which was a nice change. It added about 0.5 percentage point to net revenue.
Okay.
But for the full year so far, it's still been a drag, pulling revenue down by 1 percentage point. That's mainly due to weaker currencies in places like Mexico, Turkey, and Egypt.
So even if they're making more pesos or lira on the ground, when they convert it back to dollars for reporting, poof, some of it vanishes.
Precisely. It eats into the reported growth.
But is this pricing strategy sustainable? You keep raising prices 4% globally. Doesn't that just mean even fewer people buy your stuff next quarter? Where's the breaking point?
That really is the billion-dollar question, isn't it? They're walking a tightrope, trying to maximize revenue from price increases without driving too many customers away, maybe to cheaper store brands or just buying less.
Yeah.
For now, the pricing seems to be winning out overall, but they know exactly which parts of the business are seeing volumes drop, which leads us nicely into looking at the specific business segments. Okay, let's break down the regions, because this story of pricing versus volume isn't the same everywhere.
Makes sense. Let's start close to home. North America beverages, PBNA, how did they do?
Actually, PD&A showed a bit of improvement, some momentum. Organic revenue was up 2% in Q3.
Okay, 2%. Driven by?
Price, entirely driven by a huge 6% jump in effective net pricing just in that quarter alone.
6%. But what about volume?
Well, there's the rub again. PBNA volume actually fell 3% year to date.
Okay. Where specifically?
The main weakness was in non-carbonated beverages, think juices, waters, teas. NCB volume dropped 6% year to date.
Wow.
But kind of surprisingly, the core sodas carbonated soft drinks volume was flat. 0 change.
Huh. But maybe people are cutting back on the Gatorade or Tropicana, but still grabbing their Pepsi. Maybe they see those other drinks as more optional.
Could be. It's just a shift in what consumers consider essential versus discretionary, even within beverages.
Interesting. Okay, now let's flip to the food side in North America. PFNA, that's Frito-Lay, right?
That's right, Frito-Lay North America. And this is where things looked genuinely tough. Q3 organic revenue actually declined by 3%.
Declined for Frito-Lay.
Yeah. And volume was down 4%, both in Q3 and for the year to date. The report specifically called out a 4% drop in savory snacks volume in the quarter.
Wait a minute, Frito-Lay volume down 4%? I always thought chips were almost recession-proof, like a cheap treat people don't give up easily.
Me too. That's what makes this notable. A 4% volume decline there suggests consumers are really feeling the pinch and are cutting back even on small indulgences. It paints a picture of a pretty challenging spending environment in the U.S. right now.
Definitely something to watch. Okay, let's go international. Where did that big global pricing power show up most?
EMEA, that's Europe, Middle East, and Africa. They were the growth stars this quarter. Strongest Q3 organic revenue growth at 5.5%.
Nice.
And 6% year to date.
And let me guess. Pricing.
You guessed it. Almost entirely driven by effective net pricing. It was up 6% in Q3 and an incredible 10% year-to-date across EMEA.
10%? They're basically passing on all their inflation and then some in those markets.
Seems like it. But even with those huge price hikes, volume wasn't immune. Convenient foods volume in EMEA still dropped 5% year-to-date. They mentioned weakness particularly in South Africa and Russia.
Okay. How about Latin America? LATAM foods specifically.
LATAM foods is a perfect example of that FX pain we talked about earlier. Their reported JAP revenue was down 5% year-to-date. But that was because they got slammed by a massive 10 percentage point negative hit from currency translation. Their actual underlying business, the organic revenue, was solid, up 4% year-to-date.
So, growing well operationally, but the currency conversion just crushed the reported number.
Exactly. And finally, let's look at Asia-Pacific foods because it's the real outlier here.
How so?
Well, organic revenue was basically flat year-to-date, maybe up 1% in Q3. But here's the kicker. This segment actually grew volume. Organic volume was up 4% in Q3.
They sold more stuff.
Oh.
Everywhere else, volume is down.
Because they did the opposite on price. They actually had unfavorable net pricing in Q3, down 3%.
Whoa, so that's a totally different strategy. Everywhere else, it's high price, except lower volume. But in Asia-Pacific, they seem to have cut prices, or at least not raised them as much, specifically to gain volume and market share.
Precisely. It shows they're willing to adapt their playbook depending on the market dynamics, competition, and how price-sensitive consumers are in that specific region. Fascinating strategic split, isn't it?
It really is. Okay, so we've established the operations are chugging along, mostly by raising prices, even if it means selling less. But we have to circle back to that horrifying 29% crash in reported EPS.
Right.
That means looking beyond the day-to-day selling and into the boardroom decisions, and specifically at a nearly $2 billion bill that came due this year.
Yeah, this is where the story gets really dramatic, strategically speaking. The total pre-tax, impairment, and other charges for the year so far hit $1.96 billion.
Almost $2 billion.
Almost $2 billion. And when a company takes a charge that big, it's basically them writing a massive check and admitting, we made a huge investment in the past, and it turned out to be worth way less than we thought. A failed bet.
And the reports spell out what that failed bet was, right?
They do. It was primarily the impairment of the Rockstar energy drink brand. They took write-downs on Rockstar across several segments, North America beverages, EMEA, even the international beverage franchise unit. Plus, there was a write-down on the Ben & Shiri brand in Asia-Pacific foods.
Rockstar. They only bought that a few years ago, didn't they?
It's 2020, I believe. So yes, this impairment charge is PepsiCo effectively saying, look, we bought Rockstar, we poured money into integrating it, marketing it, and it just hasn't delivered the growth we expected. The brand isn't worth what we paid for it on our books anymore.
Wow. Nearly $2 billion to admit a major acquisition didn't pan out as hoped. That's a tough pill to swallow.
It absolutely is. But it wasn't just about writing off past mistakes. They were also spending big on new bets simultaneously. We saw significant acquisition-related charges, too, totaling $308 million year to date.
Okay, and what were those for?
Tied directly to two big acquisitions they made in 2025. First, the $1.2 billion purchase of Siete, which is a popular Mexican-American food brand.
Right, I've seen their stuff.
And second, the even bigger $1.95 billion acquisition of Poppi, the prebiotic soda company that's been growing like crazy.
Poppi, okay, so out with Rockstar, in with Poppi. Seems like a clear shift in their beverage strategy.
It certainly looks that way. And the Poppi deal had an interesting wrinkle. Part of that near $2 billion price tag isn't guaranteed. There's about $200 million classified as contingent consideration.
Meaning?
Meaning PepsiCo only has to pay that extra amount if Poppi hits certain performance targets by the third quarter of 2027. So they built in an incentive: pay more if it succeeds, less if it doesn't. It's a way to hedge their bet slightly.
Smart. Okay, so impairments from old deals, costs from new deals. What else dragged down that gap number?
Well, there's the ongoing cost-cutting drive. Remember the CEO quote about aggressively optimizing the cost structure? That's reflected in the restructuring and impairment charges related to their big 2019 productivity plan. That plan's been extended out to 2030 now, with maybe $6 billion in total expected charges over its life. Year to date, those charges were $567 million.
So continuous streamlining and cost reduction efforts are also hitting the reported bottom line.
Correct. And one last little item, just to complete the picture. Latham Foods, besides the FX woes, also got hit with an $82 million unfavorable tax settlement from some audits. Another one-time item contributing to that big gap between the reported GAAP earnings and the underlying core earnings.
It all adds up, or rather subtracts down.
Okay, let's shift gears to the capital strategy and outlook. Despite all this spending and the big write-downs, they seem fairly stable looking forward. They reaffirmed their guidance for 2025, right?
They did. They're still guiding for low single-digit organic revenue growth for the full year.
And crucially, on the profit side.
They still expect core constant currency EPS, that key underlying metric, to be approximately even with last year. Flat, basically.
Okay, flat is better than down significantly.
Exactly. And there was actually some good news on that front. Their outlook for core USD EPS actually improved a bit.
How come?
Because their forecast for that foreign exchange drag got better. They initially expected FX to shave off 1.5 percentage points from core EPS this year. Now they only expect it to be a 0.5 percentage point headwind. So the dollar weakening slightly, or other currencies strengthening, helps their reported dollar earnings.
Precisely. That improved FX forecast means the implied decline in core EPS is now tiny, only about 0.5% compared to the $8.16 they earned on a core basis last year. That's a big relief for them.
So the underlying message is, yeah, we're spending a ton, restructuring, taking write-downs, but the core engine is stable and will keep rewarding shareholders.
Absolutely. And they are definitely focused on shareholder returns. They projected giving back about $8.6 billion in cash to shareholders this year.
$8.6 billion. How does that break down?
Mostly dividends, about $7.6 billion, and then $1.0 billion in share buybacks.
Okay, but funding those returns, plus the big acquisitions.
Yeah.
Where's the money coming from? You mentioned heavy spending.
Well, a lot of it is coming from debt. The balance sheet shows a pretty significant jump. Long-term debt obligations went up by $6.9 billion just since the start of the year.
Wow. To a total of
$44.1 billion in long-term debt as of early September. So yeah, they're definitely leveraging up to fund this strategic transformation and the shareholder returns.
that borrowing shows up in the cash flow statement too, I assume.
It does. Net cash from operating activities actually dipped a bit year over year, down from $6.2 billion to $5.5 billion year to date.
Less cash coming in from the core business.
And way more cash going out for investments. Net cash used for investing activities more than doubled, jumped from under $3 billion last year to over $5.2 billion this year. That primarily reflects paying for Siete and Poppi.
Spending big to reshape the portfolio.
Right.
Which brings us to one more interesting investment footnote. That Celsius deal, it sounded complicated.
Yeah, it's another piece of this beverage portfolio shuffle. They didn't buy Celsius outright, but they acquired Series B convertible preferred shares in Celsius Holdings, valued at about $585 million at the time.
Convertible preferred. So debt that can turn into stock later.
Sort of, yes. And alongside that, they got a major distribution agreement for another brand Celsius owns, Alani Nu, starting later this year. Okay. The interesting accounting part is how they classify this investment. It's a level 3 available for sale debt security.
Level 3. That means
It means there's no active market to easily price these shares. They're illiquid. So PepsiCo had to estimate the fair value using a Monte Carlo simulation.
a complex financial model running thousands of scenarios.
Exactly. It just highlights that this isn't a simple stock purchase. It's a sophisticated, calculated bet on Celsius's future growth, using complex financial tools, probably with specific terms attached. High potential reward, but definitely not straightforward.
Okay, let's try to wrap this all up. If you had to boil it down, what's the single biggest takeaway for our listeners from this PepsiCo deep dive?
I think the major theme here is really strategic repositioning under pressure.
Yeah.
They're skillfully using their pricing power, especially internationally, to handle inflation, even if it means lower volumes in many places. That keeps the revenue stable.
Right.
But at the same time, they're being super aggressive behind the scenes, cutting costs through that big productivity plan, fundamentally reshaping their portfolio, buying Siete and Poppi, investing in Celsius while essentially admitting defeat and writing off Rockstar.
And funding it all with more debt while still paying out big dividends.
Exactly. They're spending heavily, borrowing heavily, all to pivot the company towards future growth areas while trying desperately to keep that core business humming along steadily. It's a massive balancing act.
It really is. Which leads us nicely to our final thought for you, the listener, to chew on.
Given that enormous, nearly $2 billion write-down of the Rockstar brand, which wasn't acquired all that long ago, and then turning around and pouring over $500 million into a direct competitor, Celsius?
What does that huge swing, that massive write-off followed by a big new investment in the same space, tell you about just how fast things are changing in the beverage market today? And maybe about the risks involved when yesterday's billion-dollar strategic bet becomes today's billion-dollar write-off.
Something definitely worth pondering as you watch these beverage giants continue to battle it out.